Hello and welcome to the Brent Bruce Daily. We have breaking news today. This is just amazing news that I'm going to tell you here in just a minute. Today is July the 13th, 2022. It's 10:49 Central Time, so I'm getting you a little bit earlier than I have been lately because I want to make sure that you know about this breaking news. Okay, and here it is. Inflation is really high. Okay, so I don't know if you knew that, but inflation is really high. And the reason I'm making a point of this and kind of a mockery of it is because it's amazing to watch the Federal Reserve get reports and act like they just found out about this. So we're going to take a look at a couple of articles here. We are going to get to the mortgage-backed security market in just a moment and how that's affecting the mortgage-backed security market because it has been quite volatile. And yesterday we talked about if we got an inflation number that was higher than expected, that home loans would kind of take a beating. And we're going to see what happened here because inflation came out not higher than we expected, much higher than we expected. As far as the reports, it's not higher than we really expected, you and I, because we actually live out in the real world, not in some sort of a box that we just wait for reports to tell us what's going on in the world. So I'm going to show you what I mean here. I'm going to get a little bit more animated because this is just crazy watching the way that the Federal Reserve and others are responding to this. So right here, you have a report here. This is Epoch News. I'm going to send this to you, the Epoch Times. Actually, I'm going to send this to you because this whole report is really good. This whole article is really good. It talks about, obviously, that we hit a 9.1% new 40-year high on inflation numbers, which we've been talking about here on the Brent Bruce Daily, that we know inflation is over 10%. We see it. And I'm going to show you some other numbers here that illustrate that. But I'm going to go down here to a comment that I saw from Deutsche Bank here. It says that the analysts at Deutsche Bank believe that the U.S. central banks need to maintain its hawkish attitude. However, read a little further down, in the last couple of months, consumer demand has eased and personal spending rose by just 0.2% in May, according to the Bureau of Economic Analysts. So the reason I'm pointing this specific paragraph out is because it says that consumer demand has eased. Why has it eased? Because we aren't getting money from the government anymore. We have to make our mortgage payments now. There's not rent moratoriums and eviction moratoriums. We're back to having to make our car payments. Money isn't being given to us by the government. All of these things that are massively inflationary. And that's what I was talking about months ago, in that inflation would subside naturally, maybe not all the way, but inflation was going to subside naturally because of taking away all of the stimulus and making people go back to making their payments. Remember, during COVID, we didn't have to make our school loans, our car loans, our mortgage payments. I mean, everything was, we had the opportunity, and many people took advantage of the opportunity, maybe for good reason, but a lot of people didn't have to make the payments on everything, and they were given a lot of money. Okay, so some people were receiving, $600 a month or $1,200 a quarter, whatever the numbers were, depending on your financial situation. And that money was spent out into the economy to stimulate the economy, which is a good thing, but you can't put trillions of dollars out into the economy without having inflation. This is the most basic economics. So let's take a look here. Again, this is saying that this consumer demand and spending has not gone up by as much as it was previously. Again, there's obvious reasons for that. And this should not be some sort of amazing news to people that are the smartest people in the world economically, especially the Federal Reserve. So let's take a look over here at, again, this is today's CNBC front page. Inflation rose by 9.1%. Social Security and cost of living adjustments of 10.5% because of inflation. Inflation scorcher for the Fed. Let's go down a little bit further. These are America's 10 most expensive states to keep up with inflation. Here are the 10 cheapest states. Inflation. Everything is inflation. And let's take a look at, again, this is apparently news to the Federal Reserve. So let's take a look at this report here that our friends at MBS Highway put up today. And it shows you here year over year, and it breaks down the consumer price index by a few different categories. So apparently, this is breaking news for the Federal Reserve, that energy is up 42% year over year, that gasoline is up 60% year over year, that food is up 10.4% year over year. And they're sort of acting like, well, this report just got to them. Well, again, you and I see these reports and we go, Well, yeah, no, we know. I mean, all you have to do is go fill up your gas tank to know that gasoline prices aren't up 8% from a year ago. They're up 50, 60% from a year ago. But somehow this is news to the Federal Reserve, and now they're scrambling to slow inflation. They're late to the punch here. They're late to making adjustments, and they're going to now see these numbers and go, oh my goodness, we can't raise the federal funds rate by a half. We got to raise it by 3/4. We got to raise it by a full percent. Maybe we got to raise it by more to slow inflation, because they're acting like this is news. This is brand new to them. And then they're going to go too far in raising the federal funds rate, and they're going to slow the economy. They make their decisions late. And this is what we are clearly seeing. And these reports that came out today are just so stark and so obvious that it's somewhat frustrating to watch this happen. So again, let's jump over to this other article here that says Social Security cost of living adjustments could be as high as 10.5% in 2023, according to new estimates, because Social Security and cost of living adjustments are based on inflation. So they're made to keep up with inflation. So if the government goes out and adjusts Social Security by 10.5%, now again, you look at that and you say, with inflation so high, we need to raise Social Security because the people that are living on Social Security can't keep up. And that is true. And that's why inflation is a problem. But if you increase Social Security nationwide by 10.5%, that is inflationary. Do you follow me? That is putting money out into the hands of people that then spend it, and that creates inflation. So if inflation goes up and down, let me get you on the screen here. If inflation goes up and down, okay, and it goes up, 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 and then it subsides. Then it goes up, 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 and then it subsides. What becomes kind of the stop to it coming back down is wage increase. Okay, so if inflation goes up, goes up, goes up, and then you increase Social Security, or you increase hourly wages, or you increase weekly wages, then that puts a little bit of a step up in income. So now inflation won't come down much further than that anymore. So that step up of income increase is what really makes inflation not go back down to where it was. So for instance, if a candy bar was 50 cents, and then over a 2-year run up, that candy bar becomes $1, and we increase, let's go back and say, if it goes up $1, you go, okay, well, once inflation comes back down and things settle down, then that candy bar will be worth 50 cents again. But that's not going to happen. Because of inflation, the candy bar manufacturers had to increase their wages at their factories, which means that they need to charge more for that candy bar forever. So that candy bar may come down to where it costs 60 cents, but it's not going to come down to where it costs 50 cents. And that happens over and over and over through inflation cycles, which is why I can tell you on specifically, I have a truck that I bought that is a 1982 Chevy Silverado pickup. It was fully loaded, and it was the best of the best in 1982. I looked it up, and the cost of that truck was $6,800 in 1982. So you could get the best of the best truck in 1982 for $6,800. Okay. Now go out and find the best of the best Silverado pickup truck today. What is it going to cost? I'm going to say $68,000. Okay. So that's a 10 times fold from 40 years ago. And that is because of inflation cycles up and down, and then increasing wages, like you see here, the cost of living adjustment of 10.5% to Social Security. Again, I'm happy about the fact that Social Security will increase for those people that need it. But this is an example of going back now as a result of hyperinflation. We have to increase everyone's wages. We have to increase minimum wage. We have to increase wages of anybody that wants to go to work, because no one's going to go to work if they can't afford to support their family. They might be better off staying at home. They might be better off. Like, let's say somebody has kids. Are they better off going to work and paying for childcare? Or they go, look, I can't afford childcare anymore because of inflation, so I'm better off just staying home, right? So there's a lot to think about. Inflation is a really big deal, all right? So I'm going to get off of the overall economics of inflation and what we're seeing here today. And let's take a look and see what that did to our mortgage-backed securities. So I'm going to jump into my loan sifter here. I'm going to jump into the Brent Bruce daily scenario. Again, we were looking at 5.375%. Okay, 5.375% was 0 points. I do want to point out here that I had another report come across today that said that the national average for a 30-year fixed home loan right now is 5.7% with 1 point. That is the national average, 5.7% with 1 point. We are at 5.375 with 0 points. I mean, off the charts, way lower than the national average. So let's look at the Brent Bruce daily scenario here. I always want to point that out because I hope people realize that these are real numbers. So the Brent Bruce daily scenario, where are we at? 5.5. Okay, so we knew, again, those that are watching this knew when they saw hyperinflation, all the news media is saying, oh, inflation numbers came in hot. Hopefully, those that watch this daily are saying interest rates are going to have gone up. Interest rates are going to have gone up. Now, interestingly enough, if we look at our charts, home loan interest rates took a beating this morning. They were down heavily this morning, and they've been clawing their way back up. And again, this is an inverse chart, so we want this to go up, okay? So it has been clawing its way back up, and now we're actually above the 25-day moving average. So we may see an intraday reprice that puts this back to 5.375. So why is that happening? Realistically, I think that there's a lot of people that follow the mortgage-backed security market and price home loans, that these reports, although they came in hotter than expected, we know what's going on. We don't need a report to come in to tell us that gas is more expensive than it used to be. We already know that. It's already built into the pricing. So again, here we see that this is an expired interest rate, right? I think that United Wholesale is probably going to come back here in about 20 minutes and push their 30-year fixed maybe down to 5.375 again, where we were instead of the 5.5. But as of right now, 5.5%. And again, that is because of having a super hot inflation number come out. We talked about it yesterday that if that number was hot, we would see home loan interest rates increase, but it's fighting its way back. And now I think that we're probably going to end up having home loans end up probably level today from yesterday because of, again, the expected and the anticipation. Now, one last thing before I finish up here for today is, what do we expect to happen later here in July when it comes to the federal funds rate being increased again? Well, we already were expecting a 0.75% increase in the federal funds rate. The fact that they're reacting so surprised to this report here makes me think that we might see a full 1% increase in the federal funds rate. But be wise, okay? Be wise to the fact that the last time the Federal Reserve increased the federal funds rate by 0.75%, we had a great run in our home loan interest rates, and they went down about 0.75% over the next couple of weeks. So what do we think is going to happen with home loan interest rates if they raise the federal funds rate by 0.75% or 1 full percent? We'll have to see, but there definitely is a recipe for home loan interest rates to actually either stay about the same or maybe come back down into the 4s because of the anticipation of fighting inflation. So I hope that this is making sense. Let me know your thoughts on this, and please make sure that I'm going to start putting this out on YouTube, not just through BombBomb, so that you can like and subscribe and you can start having other people pay attention to what is going on. You can repost this for yourself as well so that you're bringing this data to your clients and help them understand what to expect for the future. Thanks a lot for watching. Let me know what questions you have or your comments. Have a great day.